Securities offered through Cambridge Investment Research Incorporated, a broker-dealer, member FINRA, SIPC. Advisory services through Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Cambridge and ClearVista Financial are not affiliated. Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions.
Okay. Welcome, everybody. It's September 5th. This is the September ClearVista Financial Market Perspectives. I'm Certified Kingdom Advisor Mark Trice, joined today in studio by fellow financial professional Jesse Hamilton.
Hey, everybody.
Glad you've chosen to take a few moments to get into things and talk about what's been happening in the markets and the economy the last month or so. And it's been a busy previous month. A lot of volatility over the summer, which we somewhat expect, but we didn't see at the times that we thought we'd see it. And we're going to have continued volatility going into the fall. We'll talk more about that today, but here's our agenda for the day. We'll talk about some of the index performances over the last month or so. We'll get into some macroeconomic data, a lot of data coming out in the next couple of weeks. We'll talk about that and what the meaning of that might be for you to listen to when you do hear it come out. Mm-hmm. We'll talk about the upcoming election. We're not going to give you our preference for who to vote for, but we want to encourage you to vote. But we're going to talk about what it really means for your portfolio, what that selection might mean for you. And then, of course, as always, if you have questions, you can text us at 254-282-0495. We'll try to get to those on the webinar today. If not, we'll get back with you shortly after that.
Yeah, we got our phones right here ready.
So yeah, we're all ready for those questions and things. Or you can also email us at info@clearvistafinancial.com. So Jesse, why don't we go ahead and jump into the indices performance over the month of August?
Sure. So this is what everybody wants to hear, what happened in the large cap index, the S&P 500. Just as a reminder to everyone who's new, this is called a candle chart. Each candle shape is a day of trading. Red candles are down days and green candles are up days. So the S&P 500 actually did end up with a gain in August, but suffered some pretty significant volatility. For the first couple days of the month, you can see what happened with those gaps down. The index actually fell over 8% in those first couple of days in the month, causing a lot of panic for investors. Several global factors led to the institutional selling, which then led to the headlines and fueled further panic and losses. We'll talk about those details shortly, what actually happened in the global financial world, but some extreme volatility in the first week of the month. And
this was after having some volatility of a swing of almost 5% in the month of July. So right. A little more volatility than we normally see during the summer months when it's a little bit quieter. Traders have gone on their vacations to the beach and stuff like that.
Right.
But you can kind of see with this chart, the last couple of weeks of the month were relatively flat, moving sideways to end up the month of August. Of course, we're seeing that a little bit of a sell-off in the first couple of days of September, but that volatility is usually expected this time of year.
Right. Next, we'll cover the NASDAQ 100.
If I can move the slides. There we go.
So the NASDAQ is our tech-heavy index, cap-weighted, just like the S&P, and it's heavily influenced by those large mega-cap companies.
Which are also in the S&P 500 as well.
Yes, and it tends to be a little more volatile than the S&P. So the NASDAQ gained a little less than 1% in August, but that doesn't tell the story because in the first 3 trading days of the month, Mark, this fluctuated 11.69%.
Yeah, that's a pretty hair-raising ride.
Right. So if you're an aggressive investor, you're putting a lot of your assets into tech, and you took 3 days off and then opened your account, you were down 12%. That's pretty dramatic.
And in July, more volatility as well. That we had swings there of over 8%, almost 9%.
Right.
So July and August have been extremely volatile for the NASDAQ. Right. That's a little bit unexpected, but we may see that continue through the fall.
So a 10% swing is considered normal for this index and most indexes, but just not that quickly. So the index fell all the way down to that green candle there on the fourth trading day is right around the 200-day moving average. So it bounced on the 200 moving average on August 5th and rose till the mid-month. And as you can see, as the month came to a close, it kind of tailed off in the last week and a half of the month and showed some weakness for tech. The Magnificent Seven might not be as brilliant as they have been over the past 18 months.
And we've seen that trend continue the first few days of September as well.
That's right.
So let's talk about the Russell 2000, the small caps. We like to watch this really closely because I think it's important.
So they've been extremely volatile over the past 60 days. This index fell 1.69% in the month of August, but it moved dramatically, just like the other indexes from the end of July through the 5th of August. That was a 13.97%, so almost 14% in 4 days. That's fairly dramatic.
That's right. And then also there was a time in July that it gained 14% in just a few days as well.
Yeah.
So small caps still really volatile, always have been volatile, and they move really fast when it comes to that. But we're going to compare these large caps to small caps here in just a minute.
Yeah.
Let's talk about the long-term treasury, Jesse.
So the long-term treasury index was up 1.74% in August. It's really just moving sideways. This is good news, again, despite volatility, because it's another positive month for the index. We've been saying negative returns for so many months before this. So we like to see positive, even if it is generally sideways. Bond investors are awaiting a clear sign from the Federal Reserve.
Yeah, and that's probably why there was a little bit of gain. Yields fell a little bit in August on longer term treasuries, and we've seen that continue. I think the bond market is expecting a certain number of cuts, and by the Federal Reserve this fall. We'll talk more about that in just a moment.
Yep.
Let's see our disclosures. We'll take a minute to talk about those things and
read these in great detail.
Yes. We have to make sure that you understand that these are just indices. These are not actively traded stocks.
That's right. So let's compare large and small.
Yeah.
We've been doing this chart for over a year now. Just a reminder, the red and green line is the S&P 500. The blue line is the Russell 2000. So blue is the small companies. We've been tracking this for quite a long time, and we want these lines to be running close to each other in parallel. You can see in 2023, they diverged a little bit, and they are yet to recover. In order for us to be confident in a broad rally across the overall broad market, these lines need to come together. So notice in July, there's a pretty abrupt shift up. That was that 14% rise that Mark talked about. But then look what happened right after. It fell 14%. And now the indexes are just as far apart as they were a year ago or even before that. So in August, of course, the small caps fell back below large caps.
We like to see that the small caps are generally outperforming the large cap companies. That just signals a tremendous breadth to the market, and we're not quite seeing that still yet. So we had some improvement over the summer, and then it fell back again. We'll talk more about that in just a second.
Here's a little bit different way to look at the large cap, small cap comparison. The black line is what we're interested in here. When the black line goes up, small caps are winning. Notice how over the past year, it's kind of a negative trend. If you drew a correlation line there, it'd be down. That just means that generally large companies have been winning. But you can see in July, we had a dramatic change the other direction, which is when small caps took the lead, and then they turn right back over.
And this doesn't mean that small caps are not making any money.
Right.
It just means that if I'm going head to head with a large cap index or a small cap index, what we've seen over the last few years has been small caps have been underperforming large caps in terms of performance.
Yeah.
Okay.
But we've explained this before. There's one of two things that can happen. Small caps can grow faster than large caps and catch up that way, or they can both fall, and large caps can fall more quickly than small caps, and that would be pretty significant and mean bear market conditions or maybe even recession.
And we're really wanting to see that overall breadth to the market, and it's something that that we look at here. This is an index, Jesse. Go ahead and jump in and talk
Yeah,
about
this
this
is the,
200. This is a percentage of stocks that are trading above their 200-day moving average, which is a sign of strength.
Yeah, so we consider the 200-day moving average as a signal for bullishness. And here's as Mark said, the percentage of those all stocks on the market above that 200 moving average. So we want to see this above 70 to really confirm that we're in strong bull market conditions. And it's really just moving sideways in a trading range. It fell in August as low as 42% just a month ago.
So 42% of the stocks on the stock exchange were trading below or
Right.
above their 200-day moving
which
average.
means more than half were bearish.
Right. Okay. So this has fallen off a little bit in the first few days of September. I think it's in the low 50s now.
Yeah.
But that swings every day. That's something that it's not something that we look at every day. It's just we want to see general trends.
Mhm.
And that's important that we see that breadth. Once again, the breadth in the market.
Right.
Let's talk a little bit about volatility, Jesse.
Here's the seasonality of the VIX, which is the volatility index for the S&P 500. The red arrow is where we are now, and you can see what happens in the middle of the fall. Volatility spikes. So seasonally, we're headed for a time of higher volatility.
Now the VIX index usually, I don't even know what it's hovering around today, Jesse, or maybe 15 or 16 probably. 20 something, is that right?
Yep, 20.
20, okay. And this spiked up on August 5th
in the 60s.
In the 60s. So that was a really crazy day.
Actually historic.
It was, yes. And so that's a lot of things going on. We'll talk about what was happening there with that and had to do with the Japanese carry trade and that falling apart a little bit. There will be more of that to come. We don't know when Japan will affect that, but we'll talk about that in just a moment.
Yeah, that doesn't mean that the index is going to go up. That just means that the volatility seasonally will increase.
That's right.
So I created this chart this month to kind of take a step back and remind everybody where we are and how we got here. This is a chart of our moderate index, so a basket of roughly 60% diversified equity and 45% aggregate bonds.
Which a lot of you are holding in your 401ks.
That's right.
If you're not aware, that's what a lot of you are holding as you get close to retirement.
I want to tell a story of why so many investors feel like their performance has been lackluster over the past several years, really since COVID. The headlines are pointing out so many all-time highs, bull market conditions, and success stories. But let's take a look back at what happened since COVID. So here's our first point, COVID-19. We all know what happened in the stock market there. We took a dramatic dip in the span of a month. The COVID slump where we saw stocks fall quickly when the world kind of shut down. And then it rebounded very quickly after.
Right. I did.
Oh yeah. So next is the next chapter is 2020 to 2021, where we had this rally fueled by stimulus. We were all, most of us were getting free money from the government. There were low interest rates. The federal programs were stepping in to try to keep our economy and our world afloat and alive. And we can see what happened in the markets. So next up, the 2022 bear market, where the sugar high, if you will, fell off from all the stimulus money. Inflation hit a 40-year high in
the
June.
candy that Uncle Sam was giving us.
That's right. So 40-year high for inflation, over 7%. The Fed stepped in when that happened, and they started raising rates at the fastest pace in history. And the S&P fell over 22%. Long-term bonds fell over 40%. We all remember how that felt. Then we moved into 2023. We continued to move sideways throughout the year. Investors were whipsawed back and forth, couldn't make up their mind. And we finally reached a bottom in November of last year. And then our last chapter here is how we got to today. The October low or November low to where we are now fueled a rally through artificial intelligence, the Magnificent Seven, and some unexpected robustness from our economy.
That's right.
Pushed the indexes into bull market conditions despite numerous underlying concerns. So we've been talking about these concerns for a while. The red flags have not gone away. And then on top of that, throw in one of the most polarizing elections in decades, and you wind up to where we are today.
Let's see here. One more.
So I drew a line here.
Sorry.
There we go. One more back, please.
The slide operator has, okay.
So I drew a line here on the current price of this moderate index, and notice how it's not as high as it was in 2021. So this still has over 4.5% to go before it reaches the previous high. So we're not trying to paint a negative picture here. There have been pockets of strength in our economy, in consumer habits and spending. It's all proven to be resilient, but this is an illustration of how we got to where we are now and why you might be frustrated with your returns.
Yeah, so if your portfolio kind of looks like this, give us a call, because that's something that you may be missing out on other areas of strength, holding that basic buy and hold portfolio.
That's right.
That may be underperforming your where you could be. Okay, let's jump in here. Macroeconomic outlook reminder, folks. If you've got questions, you can text us 254-282-0495, or you can send us an email at info@clearvistafinancial.com. Don't call that number because we can't answer it during the program, but you can text it and we can look at those two different information sources.
That's right.
All right.
So Mark, tell us about the sweater weather meeting. What happened at Jackson Hole?
Yeah, I was actually close to Jackson Hole during that time, and I thought about going up and hanging out with Uncle Jerome Powell and some of the other folks up there around the world, but couldn't make it work.
Nope.
But they had a lot to say. So on the 23rd of August, they had their usual G7 economic advisors up meetings that they have at Jackson Hole every summer. I'd love to go someday myself, but I checked the hotel prices and it's pretty steep during that time of year. So the Federal Reserve Chair, Jerome Powell, gave us a very strong signal that interest rate cuts are coming soon, basically saying that the central bank intends to act to stave off a further weakening of the U.S. labor market. And his statements basically said that they do not seek or welcome any further cooling in the labor market. And I think that we're going to see the labor market report tomorrow,
Right.
September the 6th, and that will move the markets. If it underwhelms, if it underperforms what the market or what the economists expect, the market might react negatively because the Fed's is late in making those rate cuts. So we're going to have to watch that. There's also going to be consumer price index data for August coming out before that meeting as well. I expect that the Fed will lower interest rates. These are the overnight Fed funds rates, probably by 0.25%. I would not be surprised if they lowered that by a full 0.5% percentage point at that September meeting. If it's any more than that, I think that will be disappointing news to investors, and they might be concerned that the economy has cooled too fast, and that could be a problem for stocks in general. Now, let's just spend a minute here talking about historical data when the Fed does cut rates. It creates volatility in the stock market. Now, you might be thinking, wait a minute, Mark, that's a good thing, right? That it helps, with borrowing and things like that. Yes, it absolutely is, but it can create volatility in the stock market because of trying to predict how much more will they cut rates. Should we borrow now to invest in our company, or should we wait? So it creates a lot of volatility. We expect that, and that's normal, and we normally will move to make adjustments as necessary in that. So look for that. That's coming the week after next, September 17th and 18th. They'll have their press conference on the 18th. We'll be watching that word for word.
Get your popcorn ready.
Get your popcorn ready. That's what we do in our office, to try to watch and dissect what the press release says, and also, more importantly, the questions that the Federal Reserve gets from reporters. And there's only about 2 reporters in the whole pool that actually ask a meaningful question. The rest of them are pointless, but we're paying attention to those couple of questions that they get from those good reporters. So that'll be out there. There's a lot of data coming out between now and then, which can move the markets. Okay, Consumer Price Index. It actually declined in July, which I think it did last July as well, slightly. It's either flat and that's when President Biden announced that they had beaten inflation, not quite so fast. The CPI is up about 2.9% from a year ago. Food prices rose about 0.2% in July. Energy prices remained unchanged. That's good. The core consumer price index, which excludes food and energy, which I don't know why they do that, but it tends to be more volatile, rose about 0.2% in July, and that matched consensus. But those core prices are still up over 3.2% versus a year ago. Inflation is one of those double-edged swords, because even though you see inflation perhaps falling on a year-over-year basis, it's still going up. 3.2% is a full percent, almost percent and 0.2 higher than normal. And so you're still seeing prices rise faster than we'd like to see.
I think what the Fed's excited about, though, is this is the first time since 2021 that we've seen the CPI below 3%.
Yes, that is promising. What they're afraid of, and this is why they've kind of delayed making interest rate cuts, is they're afraid of that double whammy inflation like we had back in the 80s, where the Federal Reserve started cutting rates too quickly, inflation returned. And so it's going to be interesting to see what the CPI is for the month of August when it comes out later this week or next, and what the Federal Reserve will do. So we watch this closely because it does have a direct impact on you. And the consumer has a direct impact on how the market responds to those things as well. Jesse, let's talk a little bit about the ISM Manufacturing Index. This is important.
So this index missed consensus once again in August, and the details of this are really worrisome. Even though it did increase, it's below the level of 50, which is where the experts consider that contraction. So the industrial might of the economy is contracting at the current moment.
And it's been contracting for 21 out of the last 22 months.
Yes.
The economy's been cooling, albeit at a slow pace over the last couple of years. So this is real important. When we see manufacturing decrease, that means companies are spending less and preparing for, and a lot of this I think had to do, Jesse, about, hey, there was this explosion after COVID because there was so much pent-up demand that manufacturing built up really quickly, and now it's just contracting. Part of that comes into play here, but it's a little bit more concerning when you start seeing an employment drop off as well. And we've all heard of layoffs from some major companies in the last several weeks, and we expect that to continue on through the second half of 2024. And a lot of this was created and caused by the government doing reckless spending.
Yeah, the M2 mining supply is declining, and we'll have to see if businesses use that extra cash to build their future, or if it was just them surviving.
Yeah, we'll find out here in the coming quarters and stuff. Now let's talk about, here's a contrarian view as well, Jesse. Let's talk about GDP.
Yeah, they revised it up from 2.8 to 3%, raising the prior estimate. and the consensus was 2.8. So now they have beat the consensus.
Yeah, and that's a strength about the economy
Right.
that's going on now. We haven't seen since the Obama administration. We really haven't seen, except during the late teens, 2000 teens, growth above this. So there was kind of the acceptance that 1% annual GDP growth was going to be the norm, and that shouldn't be the case. And we normally expect it to be around 3 or 4% real growth in this. This is revised up. We'll see what the GDP numbers are for the third quarter when they come out in October toward the end. A lot of this had to do with people still spending more. And what we'll see is that what we're seeing is that people are spending more, not because they have the money, because they're putting more in credit cards. And that this upper revision that they had was really due to that personal consumption and services and non-durable goods. Okay. There were small downward revisions in other major categories. Jesse, I know you love talking about Japanese carry trade, so why don't you comment on this a little bit?
Well, I just threw this slide in here, trying to understand what happened, and no, it was not a global financial meltdown like some of the articles on the major journals wanted to say and scare you about. But what happened with the Japanese carry trade issue in early August was just that several large bankers and investors used the stability of the Japanese yen compared to the US dollar to borrow and leverage their funds for higher yield opportunities. It's just basically, I'm going to borrow safe money and make safe money on that money.
It's kind of an arbitrage of sorts of using currency
It's
to
a
make
currency
a little
arbitrage.
Yeah,
That's exactly what it is. And then unexpectedly, the Bank of Japan caused that stability to waver.
And the reason that it was so volatile is because a lot of these currency traders borrow that leveraged funds and do as a multiple of different things, like a 10x multiple times. So the gain is great, from the multiples, but also you have the same volatility on the downside too.
Right.
And that's so. Give us an example, Jesse, because I think you had a good example the other day.
Yeah, this came from one of our partners, but they gave the example of you show up at a Japanese bank and you put down 100,000 and you borrow $1 million on that 100,000 that you put down at 0%.
Million yen.
Yes. A million yen. So then you convert that yen to dollars and you buy a US Treasury note at 3%. Seems like a foolproof plan here, because then you're getting
except when it's not.
Except because you're getting 10x leverage on that 3%. So you get 30% return on that money. But then if the yen appreciates by 1% and you didn't hedge against that, which a lot of them didn't, your return falls to 20. And then if the yen appreciates 5%, then you just lost 20%.
Right.
So it's extreme leverage.
A lot of smart people like to use leverage and things. We think that's a little risky. And clearly on August the 5th, those currency traders did that as well. I've seen this a lot. My wife used to work in foreign exchange, and so I knew that they did this some, but I did not see anything that extreme before August the 5th.
That's right.
So how are people feeling? Let's talk a little bit about this. University of Michigan has a consumer sentiment index.
Yeah. You may only know they're football national champions, but they're really good at other things as well. They're also leaders in consumer sentiment studies. So they released their 2024 July data.
And this has been going on for years and years.
Yes.
They do this.
Yeah.
This is a index of how consumers are feeling around the country. We're going to share a few of those today.
Yeah.
But I think the main thing is that we're still not feeling well.
No. So here's the index of consumer sentiment, the main index of how people are feeling compared to years ago. This goes back to 2014. And we can see through 2022, they started falling. And really in the middle of 2022, the sentiment changed and went up and down, but generally rising until the beginning of this year. You can see where it peaked and fell off, and people have been losing sentiment through the most of this year.
This is basically, how do I feel about the future of the economy
Yeah.
and my own personal financial situation? It has been rolling off. The average, historical average, because they've been doing this since the late 90s, the historical average is around 96. And in August, that number was in the high 60s. So consumers are feeling less confident about the future than they have ever in the past. You see the chart, and the years leading up to the pandemic, it was in the high 90s there. But we're not feeling as well. Let's take a look at this from the standpoint of age groups. And the age 35 to 54 and over 55 were probably the most pessimistic.
Shocker here, the boomers have the worst attitude.
I shouldn't call it our attitude, Jesse. It's just
sentiment.
It's our sentiment about the future. Just we've been around the block a few times.
They have the most knowledge about what
could
happen.
And you millennials and Gen Z people are oblivious. we can go there if you want to, Jesse. But no, all groups, all age groups, all demographic groups are not feeling as positive about their economic and financial future as we have in previous years, especially leading up to the pandemic. Maybe the pandemic changed and made us all more pessimistic or something, Jesse.
The chart shows that it did, but the people 55 and older have been through multiple market cycles, multiple bear market conditions. They have not been through a global pandemic, but they've been through the 80s and the tech bubble, the 08
and they just
crash.
don't like it. And they just don't like it. I think we like to see a lot more positive outlook in the future, maybe not as much negative talk in the world.
Yeah.
But here we are. How do we compare from our situation a year ago? It's worse off. We feel like we're worse off than we were a year ago. And then what about buying vehicles? Well, we're not really excited about that either.
No.
And so you've seen slowdowns in vehicles. In fact, I think I read an article that Jeep was cutting production of Wranglers and Wagoneers and Cherokees and things.
Yes, if you want to go buy a brand new Jeep, this is probably your time to do it.
Yeah, probably is.
Pretty much give it to you.
We have seen prices drop on vehicles. How about for houses? Well, we know a lot of that's impacted by the rise in interest rates, and especially the younger generations. They've never experienced a time where interest rates have been so high. Now, I remember buying my first house in the 90s, and I had to pay, because I was starting out, I didn't have really the best credit, and I had to pay a mortgage of 8 or 9%. I thought that was pretty good, comparatively speaking. And we're so used to the 2.5 30-year yields and things on mortgages that this is really kind of a shocker. So we probably are. I can see why we're more pessimistic about buying a house.
Look how positive people were back in 2015 to 2020. That's
because money was
140.
cheap. Money was cheap. Money was darn cheap and almost not free, but still you had some good things. Let's talk about interest rates for a moment.
Yes, so we'll click forward one slide to the yield curve.
Yeah.
I read an article this morning that for the first time in over 2 years, technically the yield is uninverted, and all that means is the 10-year is above the 2-year.
Okay.
So this chart is still way out of whack, with the 3-month being a mountain peak compared to the 30-year. It's still reversed of where it should be. The technical definition of an uninverted yield curve, though, is the 2 and the 10 flopping, and that happened today for the first time in a very long time.
We'll see if that holds.
We'll see if that holds.
Yeah. Yeah. So we still have to see that inversion. And we said before, this is always indicated we see this inversion prior to a recession.
That's right.
And we haven't necessarily had a recession necessarily, but I would not be surprised when the third quarter GDP data comes out that we technically have been in a recession. We're just not going to see the government talk about it, especially before an election.
Speaking of elections,
yeah,
we had a really good report come out this month from our friends at American Funds. If you want to see this entire report, we're happy to send it to you. You can reach out at our text line 254-282-0495 or email us. We'll send you the full copy. It's an easy 5-page read, but I grabbed some charts from it and I thought we would share those today.
Yeah, and we'll also be hosting some events for clients in the coming month. We'll go into these in more detail. Kind of fun to look at Also, the reason that we do that is so that you don't worry around presidential election.
That's right.
Okay, so some of us may feel that the 2024 election is the most important in recent memory because they always tell us it's the most important. And it's important that we vote. Yes, our vote does matter. We should do that. Elections have, historically speaking, made almost no difference when it comes to long-term investment returns.
That's not what people want to hear.
That's not what people want to hear because it's so important. I remember in 2016, I will not name the ABC reporter, but she started crying on the air because she believed that her portfolio was going to go in the tank now that a certain person was elected president. And it's up quite a bit since then.
A little bit.
Yeah, but since 1933, there have been 8 Democratic and 7 Republican presidents. And the general direction of the market has always been up during those times. What should matter more to investors than election results is just whether or not you're invested.
Exactly.
Oh, we see people pull money out of the market because of the uncertainty behind who's in the White House.
Right.
And that's a big mistake. You should, we use technical analysis and active risk management. So we might move money from asset to asset class, but it's not something where we go and hide.
Right. And unless you have a major financial decision happening in the next 6 to 12 months, that's going to impact your family on a very real level, a very short-term financial goal, there's no reason to make a political decision about your investments.
Right. Do not make decisions about your investments based on politics. And so this year has been unique in many ways, right?
Yes.
We've had people that were anointed and people that got almost killed, and a lot of controversies and a lot of negative things going around things. In each case, the market continues to be resilient. Here's a comparison of the S&P performance between the incumbent party winning and losing since 1936. This is kind of interesting, Jesse.
Yeah, they claim that there's a very high likelihood of indication of who would win based on stock performance. I wouldn't put my money on it, but historically the data shows that equities tend to look ahead and price in uncertainty in an upcoming election. So it would seem that a bullish index performance leading up to an election suggests incumbent success.
Well, and what this means here really is that I think from a psychological standpoint of an investor is that not having any change is a confidence builder.
Right. Even if it has nothing to do with
that's
the
right.
candidate.
I mean, it's completely an emotional bias that we have. Not having a change or having uncertainty creates angst and not knowing what the future might be. But once again, we'll have to see what happens here because we technically do not have an incumbent.
Right. Technically
running
don't.
technically and don't, even though we've got one party is a past president and it's not the incumbent. And then the party that is in the power is not technically an incumbent at the top office. So take all this with a grain of salt, folks. All right. So a lot of times we see investors pour money into money market funds. And that tends to be traditionally one of the lower risk investment vehicles. And we see this during election years. By contrast, we've seen equity funds have the highest net inflows in the year after an election.
So people genuinely believe they can time the market.
Yeah, and they can. This is rarely a winning investment strategy. I will tell you, you need to vote, and you need to make an independent judgment about who you want to support. Don't listen to social media. Don't even really listen to the news. Go research and do your homework, which 99% of us will not do.
Right.
Go make an informed decision. Be an independent. And I don't mean an independent party or anything like that. Just make up your own mind.
Independent thinker.
Independent thinker. There was a video out a few days ago by an independent party former candidate, and it was kind of funny to watch because it just shows how sheepish we are. We're just like sheep and we follow the herd of what people tell us on all sides of issues. And sometimes I'm guilty of that too.
Right.
Make informed decisions, do your homework. And of course, make sure you go vote. I think early voting in certain states in Pennsylvania starts next week.
Wow.
And that's crazy, but yeah, make sure you vote.
So here's our guy getting on the school bus for those of you who have kids going back to school.
That's
right
right.
now.
It's been a few weeks, but some of you in the Northeast are just now getting back to school this week. So hope your kids are having a good time. So this is kind of a carryover from last month. We're still talking about the same things. They're still the main point. Inflation is growing at a slower pace, but we can't forget that it's still going up.
Yeah, prices are still increasing, even if they're increasing more slowly.
So we've shown how market signals are mixed, and we'll continue to watch them closely.
Yes,
The indexes are generally rising, and we've had some improved breadth versus the end of 2023, or the third quarter of 2023. Bond indexes are still struggling. Once we have clarity and direction of the Fed, I think there'll be some stability. But I think yields have been rising in the last few months on bonds and things, longer term bonds.
Right.
Because they were already baking in those future rate and interest rate cuts by the Fed.
That's right. So we know election season brings a lot of anxiety. We recognize that. We would love to try to calm your nerves. I don't know if that's possible or not, but we can always talk on the phone if you're interested. What's the solution here, Mark? It hasn't changed, right?
That's right. The solution is don't panic. You should be talking to your advisor about your situation. Look at the investing over the long haul. Don't make decisions based on headlines. My goodness, I mean, the headlines are the worst to make an investment decision because I don't know if people know this. I've never worked in a newspaper, but a newspaper friend told me one time there's a whole department that writes headlines versus the author of the article.
Right.
And assuming that the author of the article is correct, the headline writer may write something completely different than the gist of the article. So same thing with news. Cable news is very polarized today. There are business channels that they exist to try to drive fear into your heart.
That's right.
And we don't believe that, as investors that take a different approach to the world. But we still believe that the U.S. future is relatively bright. Things are slowing down. The economy will continue to operate no matter who gets elected and whether or not we're in a recession or not. Yes, it can impact us in different ways, very personally, but it is not the end of the world.
Mark, I've fielded probably half a dozen calls over the last 2 weeks about if so-and-so gets elected, I will lose everything. Or if so-and-so gets elected, we're going to make so much money. It doesn't work like that.
No, it doesn't. I hate to burst your bubble of your view and things like that, but it doesn't make that much of a difference. Yes, it can impact us personally. I personally am looking at some of the candidates are putting out their tax proposals. I'm looking at that closely because that just means, more of my money that I get to keep in my pocket, more money that you get to keep in your pocket, depending on how it's taxed.
Right.
I was looking at a tax proposal. The Congressional Budget Office puts out studies of different candidates' tax proposals and things like that. And it was talking about this tax proposal will cost the government, so many $1 trillion. And I go, wait a minute. If you're cutting taxes, that means that you, the federal government, doesn't get to get my money, but you consider it a cost.
A loss, yeah.
Yeah, a loss. And I was like, wait a minute, this is more money that a consumer voters get to keep in their own pocket. Anyway, I digress. So Jesse, I know people have questions about their 401k because a lot of our listeners have large 401ks, have been building them up over the years. What do you say about that? What can people do?
We have a great tool to help you with that. We want to partner with you because the 401k menus can be very narrow. We have a great new tool that allows us to open up the possibilities and also do some active management within the 401k.
Okay, great. And if you need that, just give us a call. All right.
We have made it through August. We're wrapping up our presentation here. Same points for our listeners. What does this mean for your plan? It just means that you should check your statements, talk to your professional, and educate yourself. I like what you said earlier, Mark, about being an independent thinker. This is a time where we need to really put our thinking caps on, stop being sheep, and learn about what's happening in our financial and political world and make an informed decision.
Yeah, it's so important. And just remember to vote, folks. Remember, if you've got questions, you can send those to our text line or our info at ClearVista Financial. And if you need to make an appointment because you want to talk about some of those things, we can schedule a phone call or in our office if you like sometime. Many of your clients, if you're a client, be patient. We're going to be calling you here in the next month or so to do some semi-annual reviews and also tax planning for the end of the year. And if you're above the age where it's okay to make qualified charitable distributions, we'll talk to you about that as well. Be patient. We'll reach out to you. And I want to thank you, Jesse, for helping us today on the program. Folks, I hope that's been helpful to you. Sorry we ran a little bit longer than we normally do, but thanks for joining us. And next month, first Thursday of the month in October, we will do this one more time. Hope to talk to you before then, but if not, we'll see you next month. Have a great week.